good evening and welcome to Money Control. I'm Karunya Rao and we are here to give you an update on what exactly is the performance delivered by HCL in the quarter gone by, Q1 of FY23, what the guidance has been like and whether or not they have been able to deliver as per the street's expectations. Joining me in today's conversation is Mayuresh Joshi. He tracks the IT space very closely. We also have my colleague Santosh Nair as well as Devangana Ghosh, who will also slice and dice the numbers for us. Mayuresh, first I want to come to you. Before that, I'm highlighting the numbers, the headline numbers, just for the benefit of our viewers. Revenues have come in at 23,464 crores, up almost 4% QOQ. Profits has come in at 3,283 crores. On a sequential basis, it's a degrowth of almost 9%. However, on a YOY basis, it's up 2.5%. New deal wins have come in at $2,054 million, registering a 23% YOY growth. In terms of constant currency, the revenue is up almost 3% QOQ, and dollar revenue has come in at 3,025 millions, up 1.1% QOQ and 11.2% YOY. Now, Mayuresh, my question to you is, this looks like a largely inline set of numbers. The street was expecting a softish quarter, and that's what they have delivered. According to your assessment, what has been the performance like?
So, good evening, Karunya. No, you're absolutely right. I think if you probably look at the top line, which HCL Tech has delivered, both in dollar and constant currency terms, more or less in line with estimates. The other element that you spoke about in terms of the different business segments as well, what you're probably seeing specifically in the services segment, they've also shown growth which was largely expected, around 2.3% quarter on quarter, almost 19% year on year. And the basic business segment that they're probably leaning onto, the engineering R&D services, that has shown a very robust growth as well. However, I think on a little bit of a disappointing front, I think the EBIT margin which came at 17%, the street was of the belief that EBIT margins could come close to 17.5%. So I think the margin compression, both in terms of higher employee costs, probability of more outsourcing happening at this point of time, and elevated expenses when it leads to travel, specifically on-site operations, is something to be seen. But coming to the product part, as seen in the press release as well, Mode 1 was obviously expected to remain soft in the transition that they are doing. But Mode 2, Mode 3 have shown reasonable amount of growth. Yeah, so sum it up, I think inline set of numbers, but I think the EBIT margin has been a little bit disappointing as per street expectations.
Okay. Devangana, earlier in the day when we were discussing about what to expect from HCL's performance, we did touch upon the fact that constant currency and dollar revenue, these will be in the range of 1 to 2%, and that's exactly what they have delivered. So talk to us about what else are the big standouts for you when it comes to the Q1 report card. Anything that you want to flag off in terms of performance highlights?
I think the net new addition has been at 2,089 this quarter, which is, I think, lower than what was reported in the same quarter last year. So I am just going through the numbers on that. Additionally, the product and platform business has shown slight growth. I think probably on the lower base last quarter, it has gone up 5.1%, but on a Q-on-Q basis, I think it's still at minus 6.5% growth.
Okay. Santosh, what about you? I mean, the street was rather disappointed when TCS, failed to live up to the expectations. And this one is, something on expected lines, no negative surprises or significantly negative surprises other than, what Mayuresh was mentioning on the EBIT margin front. How do you think the markets will digest this? Santosh, you're on mute.
I'm sorry, Karunya.
Yeah.
Inevitably, there will be some kind of parallels drawn with TCS. Now, being the market leader, when there's been a slight disappointment from TCS, right? Market is likely to look at the numbers of other companies in the context of how TCS has fared. So, in this case also, see the margin has been a bit of a disappointment, slightly below what market was expecting. But the margin disappointment, if you see in case of TCS, was much sharper. Also, if you look at HCL Tech, its performance throughout in 2022 so far, it has fallen close to about 30 odd % from its high. So a lot of, I think, negative sentiment was already been factored into current prices. So I think the market will, take this as an okay set of numbers. That would be my reading of the situation, Karunya.
Okay, all right. Mayuresh, what should we make of the management commentary? I'm reading at, Vijay Kumar's quote here.
Yeah.
He's the CEO and managing director. He said that operating margins, yes, they came in at 17%, but they've put in place the right measures and they look forward to improving their profitability going forward. Of course, we know that Q1 is typically, a seasonally weak quarter, but given that there is very little to work with in terms of forward-looking guidance for the next couple of quarters, what do you think we should expect in terms of performance? Because market clearly is reacting to worries of recession in the US, a demand slowdown, attrition, of course, and talent crunch has been something that has been ailing the sector as well. So going forward, what should one expect in terms of performance?
So 2, 3 broad aspects, Karunya. I think if you probably look in their entire product suite, the mode 1, which is their core product, obviously I think is showing signs of weakness in the core portfolio. And the weakness is known to the market. So I think the entire shift that they are probably doing to a SaaS based subscription model, and they're streamlining their product sales, they're more or less expecting mode 2 and mode 3 to compensate for the same. The other element that probably comes through in consonance with what I'm saying right now is the deep capabilities that HCL Tech has in the IMS space. And they've got very, very strong strategic partnerships in a lot of these Fortune 100, 500 customers where they have a strong presence at this point of time. So digital ER&D is expected to grow at a very, very healthy clip, Karunya, anywhere in the tune of 8 to 15 odd %, and reach almost $500 billion odd dollars, where HCL Tech probably wants a sizable share in this. The third element, which probably also comes through on their product and platform business, is how do they probably increase the indirect channels, the increased profitability for IP-led partnership products as well, and the shift to a subscription model. However, I think with the wage hikes expected to come through and spread over Q2, Q3, margins are going to remain a tad bit under pressure. Though I think the guidance that they've given for FY23, they're still very, very confident, Karunya, of maintaining a EBIT margin between 18 to 20 and posting a 12% currency growth.
But the guidance that they've given for 18 to 20%, I mean, this time around 17%, yes, definitely a tad below that range. But do you think they can make up for it in the next 3 quarters?
So typically, I think if you're expected to enter into a recessionary phase globally, IT spends at this point of time might not get curtailed if it's going to be a soft recession, and nobody has a clue whether it's going to be a soft or a hard landing over the next couple of quarters. Typically, IT companies, the budgeting probably happens for the US and the European clients at the end of Q3. So I think Q4 is when the budget probably happens, and Q3 is a lot of furloughs that probably come through. So I think it's a little bit tough, in my opinion, in the environment that we are in. But if they're able to do that and walk the talk, which we'll only know in hindsight over the next 3 quarters, I think that will be a commendable task. But I think it's a tall task in terms of accomplishing that with the EBIT margins on the cost pressures that probably a lot of these IT companies face.
Okay. Debanga, I want to talk to you about the total headcount, which has come in at 2.1 lakhs, up almost 20% year on year. Again, what is your sense on the way the hirings are happening in some of these big giants in the Indian IT services space, and has the concern been eased now that for several quarters they have repeatedly ramped up hiring, they've done wage hikes, etc.
But here in this particular set of numbers, I'm seeing a similar trend with what we saw with TCS last week. The net hiring this quarter has been at 2,089 for HCL Tech, which is significantly lower than what happened in Q4. Q4, the number was 11,100, and on a year-on-year basis, in the same quarter last fiscal, it was at over 7,500. So in that comparison, just like we saw in TCS, the net hiring, net addition is quite low this quarter. which again brings us to the question of demand. Is the demand slowing down for IT companies? That probably we'll get to know further once the press conference begins. But overall, the company, as per Q4 estimates that CEO CVK had shared, he wanted to add, he said that he has a target of adding 45,000 freshers this fiscal.
Okay. In terms of segmental performance as well, I'm just looking at the release once again. Growth momentum was led by tech and services. There was telecom, media, publishing, entertainment also, which contributed a fair bit. In terms of markets, the growth was powered by Europe, followed by Americas, and then the rest of the world. So, is the split also largely something that was on expected lines?
I think so. I think so. This is
Okay.
more or less what the mix has been happening for HCL.
Okay. I also want to, bring on board Santosh to talk more about what's happening with some of these IT stocks. Actually, most of these IT stocks. The commentary has not been as alarming or as weak. The markets have reacted quite a bit to these concerns that are playing out in key global markets right now with respect to recession, inflationary pressures, rising interest rates, corporate earnings also kicking in the US as well. Talk to us about whether or not this kind of a sell-off that we've seen in the IT space is justified, because no management or nobody has really sounded off any caution yet. Is it justified according to you? Again, you're on mute.
My apologies again, Karina. I think Mayuresh again had touched on the same point just a short while back when he said that, this whole thing about recession, it is still early, and also when they drop the budgets, it will be only in a couple of quarters from now that we'll really get to know. So at this point, it's really speculation. Probably the market has kind of overreacted. You're seeing the IT index already down 30%, this despite the fact that the earnings momentum has been much better. The other two sectors which have fallen as much are realty and commodities. So IT has fallen as much as those sectors where there is even less earnings visibility. So I think to a large extent, whether it's justified or no, it's hard to say. But with a big fall having come through, I think analysts and the market seem to be in some kind of a wait and watch mode. The TCS guidance also said that, we are fine for FY23 and we'll see for FY24. So at this point, I think there's a fair reason to believe that the worst may already be priced in. Maybe the market will wait for some more time, another couple of quarters, to see if there's actually any signs of demand slowing down.
Okay, but valuation-wise, is the street more comfortable now, or do you foresee more pain? I mean, I want to ask you this as well as Mayuresh. So, Santosh, why don't you tell us first and we can take it across to him?
Well, valuation, I would say that, in most cases, we have not seen any earnings downgrade come in. I think probably Mayuresh will be in a better position to comment on that. I think everyone is working with the previous set of earnings. And if you work on the basis of that, probably, prices are looking more attractive after the 30% fall. But now if the denominator changes, that's where, probably we'll get to know what valuations these stocks should ideally be quoting at. So I think we're still at least a couple of quarters away before we get some kind of a handle on, what the demand situation is likely to be.
Mayuresh, many people we've interacted with in the recent past, we're starting to hear some positive views on IT stocks, especially blue chip names like a Wipro and Infosys, HCL Technologies, even TCS, that now they look attractive. What is your view? Do you concur with the fact that valuations have, come down to a point where people can start buying in?
So currently, I think valuations have definitely come off from the peaks. But as Santosh alluded to, I think, and what I also mentioned, I think there are some gray areas which the market and the street is not aware, is probably not cognizant of at this point of time. Now, our US firm and our team in the US, when we speak to a lot of clients and the IT guys in the US market itself, I think they're more product-oriented guys, Karunya. So I think they are feeling a lot of heat at this point of time. But our companies, like an Accenture, are more outsourcers. So the common thread that is probably running through at this point of time, specifically even at this point in a post-COVID world, IT budgets might not get slashed as much as the street is fearing or expecting. Yes, if the recession probably gets prolonged, if it's a hard landing recession, you might have some curtailment happening, but not a complete one. So you've seen a transition of change happen over the last decade or so, where I think the optimism in terms of IT actually being a very cost-effective tool for a lot of firms globally, I think still remains the focal point. When it comes to valuations per se, I think valuations have definitely come off, as I said, from the peaks. But because the sector might consolidate because of all these factors on hand, my own sense is that there might be a couple of pain points, both in terms of what the global IT sector is doing, completely, I think, ignoring the outsourcing story at this point of time. And second, watching out for data points in terms of how the EBIT margins are probably bottom out in the next quarter or two. So I think it's more or less a consolidation phase where a lot of stocks might actually go to a range-bound move over the next quarter or so.
But at a time when rupee weakens, people usually talk about IT and sectors like pharma as well, which could benefit from it. Seldom, do we talk about the downside risks and other challenges also that come, along with it, especially in times like this when US demand is likely to witness some slowdown in the coming quarters. So, what would be, the top downside risks that investors, especially retail investors, should watch out for right now before deciding to get into any of these IT companies?
So Karuna, as far as the rupee against the dollar trade goes, I think the depreciation does act as a tailwind, but it is only to a certain level because I think there's a lot of hedging mechanism that IT companies adopt too. And I think the kind of tailwinds that come or accrue to these companies are probably offset because of the other currencies. You've probably seen how the euro is against the dollar at this point of time and the other currencies as well. So I think that probably gets offset to a large extent. So I think the full benefits of a depreciating rupee do not probably flow in. So that's point number one that I want to make. The second element in terms of the placement for the sector as a whole, as I mentioned very categorically, I think the sector probably is poised. I think there are a lot of concerns that are being put out for the sector as a whole. That is getting reflected in the price as well. But let us not forget, I think the outperformance for IT, whether it's large names and mid-cap IT in particular, I think the kind of outperformance that has happened over the last 2 years, I think there will be some amount of moderation that probably come through. Analysts at this point of time might not be willing to probably look at cutting down their estimates, at least looking at management commentaries. And therefore, it becomes a very tricky situation where I think the price damage has already happened for the overall sector as a whole. Whether there might be some amount of price damage for certain selective stocks which might not perform in view of street expectations, I think that is a case in point. But largely, again, I think this sector is going goes through some sort of pain for all these points mentioned. And therefore, I think consolidation in terms of price action might very well continue for the sector as a whole.
Since I have you here, I also want you to help us understand how are things likely to play out for some of these mid-cap IT names. Their earnings are also lined up this week. There's Mindtree, L&T Tech as well, and several other which will follow. So how's it looking for the mid-cap space?
So largely, again, I think if you look at the trajectory on how these mid-cap IT companies have been performing, I think the typical order flow currently happens between $1 million to 5 to 10. So I think that is a typical bucket size that we are probably looking at. So I think the large multi-million dollar deal that accrue to these bigger firms, I think the smaller firms are well off in terms of gaining these smaller orders because the big firms do not probably vouch for that. When a soft landing or a recessionary environment probably comes through, what we are probably seeing in the Western environment at this point of time, I think these smaller budgets might get curtailed by a larger amount. By what I mean is if a firm is probably wanting to give out a 5 million order, they probably might slash it down in a larger percentage compared to the larger orders that probably come through. And it does matter a lot for these mid-cap IT companies in terms of order wins, because on that basis, I think the revenue visibility and the entire cost structure is probably dependent on. They're facing the similar issues of attrition. They're facing the similar issues in terms of margin headwinds. And therefore, if orders slow down larger in proportion to what the bigger guys get, I think the overvaluations compared to the larger IT space, they might actually come down in terms of expectations that probably come through. So yeah, I think the risk factor for mid-cap IT companies not meeting street expectations is far larger than the larger IT companies.
Okay, all right. Steering back once again to HCL Technologies, Devangana, the press conference will start any minute now. But what are the top things to watch out for as far as the commentary is concerned? What will you be looking out for?
I would want to know more about how they're training, because they're currently heavily investing on training their new hires and are planning to hire more. They're looking into the near shore delivery uh, plans and other things, skilling overall. So would like to know more about what they're doing there. Would like to get a sense of how the company and the business is going to play out for them in the upcoming quarters, given the macro headwinds that we are seeing currently. There is obviously cross-currency headwinds as well. Um, Plus, I think, like I was also mentioning in the morning, TCS had also sort of cautioned that despite a strong deal pipeline, the company is going to stay vigilant. So would like to know more about how HCL is looking at the same.
Okay. And Santosh, how do you think the market will react to this particular stocks tomorrow? Not only the stock, actually, the entire IT pack, because we all know what happened after TCS's numbers. So what's likely to happen tomorrow morning? Santosh, you're on mute again.
I'm sorry again, Karunya. No, I think this is purely going by the price reaction over the last couple of days. So I think a lot of negativity is already reflecting in the prices. So we didn't see any kind of a panic sell-off in IT, which is what sometimes we see when there is huge disappointment. This is partly could be due to the fact that already stocks have corrected quite a bit. And now I think market will be looking closely at individual companies to see where the big misses or surprises are. So it's likely to be more of stock specific, I would say. And this number, though it's in line with expectations, I would think that stock probably might just do about okay. That's my take.
Okay. And given that a lot of earnings are, of course, lined up, this is only the tip of the iceberg, the second, result report from the IT pack. Which one will you be watching out for closely this time around? Any names that excite you?
Just to me.
Yeah.
Well, I would say the mid cap space, in fact, all of them. That is where the big moves are likely to come. That's the place where market would be watching closely. And I would say the entire mid cap space.
Okay. All right. Well, guys, thank you so much once again for joining in and for sharing us, a 360-degree view of how the earnings have panned out. The press conference is starting in just moments from now, so stay tuned. We'll be, airing it live here on this very stream itself. Thank you once again, Santosh, Mayuresh, and Devangna for joining in. And guys, stay tuned. The press conference starts in a minute.
press conference. We hope that you and your families are safe and in good health. I am Megha Kaul and I would be your host for today. Before we begin the conference, I would like to share some key instructions with you all. During today's conference, all attendees will be in listen-only mode. For the best experience, please select the stack and full screen view on the top right of your screens. If you have joined from your phone, you can double tap on the hashtag HCLQ1 window for a better visual experience. There will be a Q&A session at the end of the conference. In case you drop out, please rejoin us using the same invite link. If you experience any technical difficulties, you can message us using the Q&A panel. Today we have with us HCL Technologies Chief Executive Officer and Managing Director, Mr. C. Vijay Kumar, Chief Financial Officer, Mr. Prateek Agarwal, and Chief Human Resources Officer, Mr. Appa Rao VV. I would now like to hand over to Mr. C. Vijay Kumar. CVK, over to you.
Good evening, everyone, and thank you for joining us for HCL Technologies' first quarter earnings announcement. At HCL Technologies, we continue our journey with 5 key strategic objectives. First being leadership through differentiated products and services. 2, to become the employer of choice in our chosen markets. And the third objective is to be the preferred digital partner for Global 2000 enterprises in our chosen markets. The fourth objective is to weave ESG through our sustainability goals through ACT, PACT, and IMPACT. And of course, the fifth strategic objective is to achieve top quartile total shareholder returns over the medium term. I'm happy to share that we've started FY23 on a strong note with a healthy performance in Q1. Our revenue growth this quarter came in at 2.7% sequentially and 15.6% year on year in constant currency. Our services business continues to deliver increasing growth trajectory, growing at 19% year on year and 2.3% sequentially in constant currency. The growth momentum in our services business is led by our engineering and R&D services and our digital application services, with cloud transformation being a central theme across all the services and verticals. We also saw a strong recovery in our products and platform business, which grew 5.6% sequentially and 1.4% year on year in constant currency. When it comes to margins, we posted an EBIT performance of 17% this quarter. Margins in the services business is under pressure, mainly due to increased talent costs and transition costs. We have undertaken appropriate actions to improve our profitability profile, the results of which would start reflecting in the coming quarters. The margin improvement initiatives include both revenue and cost levers, led by innovative pricing, rate increases, and optimization of the operating costs, both people and non-people costs. From a segmental performance, our engineering and R&D services business led the charge with a 3.7% sequential growth, followed by our ITBS services at 2% sequential growth in constant currency. We are witnessing a number of end-to-end engineering services deals. We signed 2 large ones in this quarter, one with the European ISV and another one with a global ISV. Within the IT and business services, the growth was driven by digital application services, with the momentum in enterprise spending around customer experience, operating model, IT operating model transformation, and also through our cloud smart offerings, which have become a differentiator for us. We also signed several significant deals in cloud and other digital transformation areas. A large global European bank selected us for enabling its cloud transformation and overall hybrid cloud operations. One of the largest healthcare providers in the US selected us to help transform its infrastructure landscape by kickstarting the cloud journey. A Europe-based leading global consumer goods and retail company selected us to deliver its future digital and IT roadmap through cloud migration, a digital workplace, and direct-to-consumer multi-channel platform development. Starting this quarter, we are aligning our metrics disclosure to services and product businesses separately. In services business, we would be providing you the split for geographies and verticals. In terms of geographic growth, our growth was led by US at 2.8% sequentially in constant currency, followed by Europe, which posted 1.6% QOQ growth in constant currency. In terms of verticals, technology and services and telecom and media were our top performing vertical segments with 10.9% growth and 4.3% sequential growth in constant currency. Our life sciences and healthcare business grew 2.7% sequentially in constant currency. Talking about the bookings and pipeline, we again had a very strong booking this quarter, crossing $2 billion with 16 deals in products and services, 16 large deals across life sciences and healthcare, manufacturing, financial services, and technology segments. Our bookings grew 23.4% year on year, supported by a good mix of large and mid-sized deals. Our pipeline continues to remain at record high levels. It's well distributed across large deals and medium-sized deals. Moving to our corporate sustainability agenda, we are continuing our commitment to be net zero by 2040. Our GHG emission reduction targets for 2030 were validated by Science-Based Target Initiative to be aligned to the 1.5-degree pathway. We are committed to develop products and services to enable our customers' sustainability journey. On this journey, we launched our first comprehensive sustainability-focused solution called as Net Zero Intelligent Operations, NEO, which helps organizations collect real-time data around energy consumption and analytics at scale to deliver actionable insights to our clients. We continue to see a strong momentum in the market. We remain very positive about our growth trajectory moving forward. We are very focused on profitable growth and in a manner that we can sustain industry-leading performance. With this overall commentary, I'll ask Pratik to provide some next level of financial details.
Thank you, CVK. To give you the highlights from a financial point of view, starting with growth, 2.7% is the growth on a sequential basis, 15.6% year on year for the company as a whole. But obviously the key highlight for the company is the services growth on a year-on-year basis, which came in at 19% in a constant currency basis. The PNP growth also was at 1.4% on a year-on-year basis after excluding the impact of the divested CFT business that we let go last year, same quarter. The services growth driver was ERS, which grew at 23% year on year, but ITBS also grew at 18%, all very healthy growth numbers. PNP grew 5%, 5.1% on a sequential basis, which was also helping the services growth of 2.3% and moved the company total to 2.7 on a sequential basis. As far as rupee terms is concerned, the rupee revenue came in at 23,464 crores, which was up 16.9%, almost close to 17%. And EBITDA was at 21.2%, and profit after tax came in at 3,283 crores, which was 14% of revenue and 1.4% growth year on year in net income terms. With that, I move on to the booking performance, which was $2,2054 million to be precise, which was a good 23.4% growth. And even in ACV terms, it was a good growth of close to 18%. We also increased our customer numbers. 100 million customers went up by 3 numbers on a year-on-year basis, and $50 million customers went up by 5, again on a year-on-year basis. We generated $2 billion in the last 12 months in cash generation terms, operating cash flow that is, and free cash flow came in at $1.76 billion, which is respectively 112% and 98% of our net income. And our balance sheet remains strong at gross cash of $2.25 billion. In shareholder terms, the last 12 months diluted EPS amounts to 50 rupees and 06 paise, 50 rupees round number, which is up by about 0.6% sequentially. And the board has approved a dividend of rupees 10 per share for the quarter, which will be, the record date will be July 20th, and the payout date would be August 2nd. With that, I'd like to hand over to Appa, our HR head.
Thanks, Pratik. Good evening, everyone. Hope you and your families and your near and dear ones are all keeping safe. As far as HCL employees are concerned, I'm glad to report that we have our employees are all safe along with their families, and our vaccination levels are at a very record level. And we don't see much of an impact of COVID. The active cases are very few. So we have a very healthy workforce with us as we speak. Coming to the talent segment, we added 1% headcount the quarter on quarter, which is around 2,089 employees. We are focusing on our utilization. We had a great year in recruitment. Our headcount last year grew 23.4%, and we are utilizing what we have hired in a better manner. And very heartening thing for us is our diversification in terms of geographies. Our new Vista locations, which are Madurai, Lucknow, Nagpur, and Vijayawada, our headcount grew by 30.5% year on year, which is very, very heartening for us, because our supply chains will get distributed, new talent markets we explore. And same is the case with our global new frontier countries also, which are Poland, Bulgaria, Romania, Portugal, Spain, Mexico, Guatemala, Brazil. There also our headcount grew to a healthy 30% compared to the previous year on year. And we crossed, in India, we crossed 20,000 people in our new Vista Center, and in new frontier countries, we crossed 18,000 people. This gives us a very good spread, both in terms of talent sourcing as well as any business continuity operations that are required. We added 6,023 freshers this quarter, which is almost 100% increase compared to the same quarter last year. And we are planning to onboard another 10,400 freshers in this JAS quarter. I mean, from training perspective, we spent 2 million hours this quarter, and almost 44,000 people got upskilled and deployed this year. And our internal fulfillment rate, because of training, both in generic skills as well as in niche skills, has increased significantly, and internal fulfillment rate is touching 50%, which is quite healthy. We will only concentrate more to increase these levels. Coming to attrition, we are definitely seeing an increased attrition. Last quarter, we ended up an LTM attrition of 21.9%, and this quarter it is 23.76, almost a 180 basis points increase. We still see heightened attrition, and next quarter also will remain more or less same. And we are seeing some green shoots in terms of attrition coming down, but not significantly. So we do hope in a quarter or two it will start stabilizing and coming down. So that's our expectation. Our return to office, employees coming to office still is limited to 12 to 15% levels. We are having employee connect programs in terms of looking to see how we enable them. But from a unique employees perspective, more than 50% people have visited our offices in the last 3 months. So that's a very heartening sign. We feel that employees would like to come back to some level. So we are pivoting towards a virtual hybrid model, and I think our efforts are in that direction. So with this commentary on HR, I'll pass it on to Megha for Q&A.
Thank you, Appa. We will now be opening the floor for questions and answers.
Thank you, Megha. Ladies and gentlemen, if you've joined us from the WebEx mobile app, please tap on the 3 dots on the floating panel on the bottom of your screen, and then tap on the raise hand option. In case you are on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your line. And in case you have joined on audio only, please press *3 to raise your hand. Our first question is from the line of Anisha. Anisha, I'm unmuting your line. Please go ahead. Anisha, can you hear us?
I can hear you. Can you hear me?
Yes, we can. Loud and clear. Please go ahead.
Hi, sorry. I'll take one question at a time. First, coming to you, CVK. I know you talked about how the services business continues to perform well, but purely from the point of growth rate, that seems to have slowed a tad bit because your services business grew in constant currency term at 2.3%. And if I remember it right, this number was 5% last quarter. I understand there would be a higher base as well, but just to get a sense in terms of how the demand momentum is looking like and what kind of growth rate we should expect for services going forward.
Yeah, so we have grown 2.3% after 3 consecutive quarters of 5% plus sequential growth in services. So to get a good perspective, you should look at a 19% year-on-year growth in constant currency. That would be the right metric to look at, and it's really a fantastic growth on the services business. Now, moving forward, while we don't give you a quarterly guidance, we've given a 12 to 14% guidance for the full year in constant currency. We are reasonably confident of achieving those numbers. And the booking this quarter has increased 23 plus percentage year on year compared to what it was last year. And the pipeline continues to look quite robust. So we foresee a good growth trajectory in the services business moving forward.
Sure, point taken. Prateek, coming to you on the margin front, of course, this quarter, the overall sector is facing a lot of supply side issues, and that's similar for you. But what makes you confident of achieving that 18 to 20% range? And should we expect a bounce back in Q2 itself, or will it take time?
So Anisha, I'll pass on your second question because like CVK said, we do not give quarterly guidance. But coming to your first one, I think there are a range of metrics and levers that are available to us, both on the top line side as well as on the cost side. On the top line, we have already started seeing green shoots in terms of getting increases in various ways and methods from our customers. So that we are quite sure will speed up and get expedited over the next few quarters. Equally on the cost side, the large number of freshers that we've taken over the last 5 quarters, including this quarter, that number is starting to become productive and billable. And that is the other big lever that we have, which is improving our pyramid and our average costs. And that, as it keeps on delivering, it will improve our margins going forward. Similarly, utilization and automation, more offshoring of the work, and so on and so forth. There are a number of levers that are available, which we are banking on to hit our at least the lower side of our range of margin guidance that we have given.
Sure, Pratik. I didn't mean to put you on a spot to give me a very quarterly, update in terms of margin guidance. But what I'm trying to understand is the bounce back going to be sharp, or is it going to be a slow and steady rise? That's my limited question.
I think it will be the latter, the slow and steady thing. I don't think anything is going to change drastically overnight.
Sure. Ababai, let me come to you and ask you about the hiring trend. This quarter, the number seems to be a tad bit lower, versus what you did last quarter. If I remember it right, last quarter, the net addition was around 11,000. This time, the net hiring is just 2,000 or 2,100 thereabouts. Now, given the fact we take headcount as one of the leading indicators of growth, should we be worried that there is a bit of a slowdown? And not a bit, actually, it's quite a bit, 2,100 versus 11,000.
Yeah, that's true. But you have to see on the backdrop of 23.4% headcount increase that has happened last year, and also 100% increase in freshers we have taken this quarter. So if you add up all these and connect the dots, it's not less.
So what will be the hiring target for the year in that case?
We don't have a visibility how much we will hire. We are sure about how many freshers we will take. So that will hover around 30,000, because this quarter we are taking 10,400. So it will be quite high in O&D also, and a tad low in JFM. And rest of it will be demand driven as well as the utilization driven for us.
Sure, I'll join back in the queue to allow others to ask as well. Thank you.
Thank you, Anisha. Our next question is from the line of Romita. Romita, we are unmuting your line. Please go ahead.
Hello.
If we can hear you, go ahead.
Yeah, hi. I think I would just like to build upon Anisha's query that, in terms of fresher intake, you had in the previous quarter mentioned that you expected around 35,000 freshers this fiscal. You just mentioned it will be around 30,000. I'm just trying to understand if you have kind of realigned the guidance for freshers. That is one. And also, overall, do you expect some kind of normalization in the hiring requirements this year, this entire fiscal?
No, we have not lowered the guidance as far as freshers are concerned. I mean, in fact, we are ready to recruit more. It is business driven. We are currently definitely targeting anywhere between 30 to 35,000. We have not lowered that part.
Got it. A query for CVK would be, sequentially retail and manufacturing are a tad bit down. Can you, explain what has happened over there? Also, just in general, with respect to long-term transformation projects, or just generally with your clients, what is the demand situation like? Do you see clients having any kind of, concerns or queries about an impending slowdown in the market?
Yeah, Romita, I think if you look at our year-on-year growth in verticals like technology, it's over 30%. Telecom, media, entertainment is close to 30%. Life sciences and healthcare is 15%. So across all verticals, barring retail CPG, we've had some excellent growth metrics on a year-on-year basis, and mostly sequentially as well. But in some verticals, there will be project completions and some one-time work which would have got completed. So that will have some impact in the revenue numbers, growth numbers. And we expect to see a good positive trajectory moving forward, even though there is concerns on slowdown. Our pipeline continues to be at an all-time high. There may be some small projects here and there which may get deferred, or there may be some delays. But structurally, I do believe the trend is intact. The customers are looking for transformation programs or continuing their transformation programs. There is a little more heightened emphasis on cost takeout kind of programs. And HCL has a pretty robust portfolio of change the business and run the business across both products and services. So I think we are well positioned to do well in the market which is growing, where there's be a lot of digital transformation spent. And if the market is a little challenging, we do think a lot of run the business type of transformation which will come our way.
Understood. Just one last query, if I may slip that in, would be purely on the products and platforms business. What is the outlook like for the fiscal?
Yeah, we don't give any segment specific forecast. Overall, we've given a 12 to 14% organic growth in constant currency, and we will stay with that.
Thank you. Thank you.
Thank you, Ramita. Our next question is from the line of Nallur Sethuraman. Nallur, we are unmuting your line. Please go ahead.
Good morning, gentlemen. So I just wanted to know, so the net hiring dropped this quarter. So does it actually show that any kind of moderation in terms of the deals, or like are you seeing any kind of slowdown in terms of client spending, or the overall macro environment seems to be slightly challenging? So I would also like to know more about your commentary about like how that would impact HCL over the next few quarters. Thank you.
Yeah, I think net hiring numbers also have to be looked at from a year-on-year perspective. We've been hiring a lot in the last 3-4 quarters prior to this quarter. And even in this quarter, we hired a significant number of freshers, while net addition is 2,000 plus people. I think the freshers are all trained and they're already deployed, and we have some additional capacity which we can utilize to continue to grow. So it's always a balancing act between how much capacity that you build up to deliver growth. And we continue to remain very positive on the 12 to 14% guidance that we've given. So whatever is required for that, we've already hired. And this quarter, again, we expect to have robust hiring.
Sir, on the macro environment and the client spending?
Macro, yes, of course, there are most of the verticals, we do not see any concern, and they continue to look at their transformation programs as being mission critical, and they're continuing to walk the path in expanding or even completing programs. But there are some pockets in manufacturing and maybe retail CPG. We are seeing some projects which are getting delayed. But in the larger scheme of overall portfolio and the service mix and the vertical and geography mix, as I said, our pipeline is at an all-time high, very near to an all-time high. So I think we don't see that to be a factor that will impact us. So far, we haven't heard much. We continue to remain very vigilant to see what's happening in the environment, how it will impact us, how we can help our customers. All of that remains very central to our strategy.
So the delay you mentioned is about the client spending or the execution of the projects?
No, nothing really significant to call out. It's just some small projects here and there could be delayed, but in the larger scheme of things, I think the trend is intact.
Thank you, Nalur. Yeah, we'll just move to the next person. And you can email us questions in case you have any follow-up questions. Our next question is from the line of Surbi. Surbi, I'm unmuting your line. Please go ahead.
You as far as the environment is concerned, we've heard from some of your peers as well as there's some concerns about the inflation in the US, which is the largest market for you and other companies. So what is HCL's experience like? Are you also experiencing some sort of stress from the clients, which may lead to some kind of a slowdown in spending or deal cancellations?
See, I think you know as much as what we know, and then the incremental data points from our clients is really, if I want to look at it very objectively, it's reflected in our pipeline. So while there is inflation, while there is a little more focus on costs and customers preparing for a slightly higher inflation environment, but they continue to have programs which helps them to be viable either by cost optimization or continuing to drive transformation, while transformation helps in customer experience and supply chain management, new initiatives around omni-channel and things like that. But it also is one of the central themes to really reduce the overall operating cost. So I think technology will continue to be a very, very important tool customers will use in a high inflation environment.
Thank you, Surbi. Our next question is from the line of Jatin. Jatin, unmuting your line. Please go ahead.
If you can confirm that, and what's the plan for July, September?
Sorry, what plan are you asking about?
Fresher addition number for April, June, and how much you plan to add in July, September?
So we added, as I mentioned, 6,023 in AMJ, and we are targeting 10,400 in JAS.
Okay. One more thing on, can you please also give us how much consumers you've added sequentially in April, June?
I think it's there in our IR release. We have pretty healthy client additions across all the categories. I don't have specific numbers.
100 million we added one client, 20 million plus we added 9 clients, and so on and so forth. I think it was 15 for 10 million plus. It's there in the release. These are the highlights.